Okay, good. Thank you very much, and welcome to Dorset Pension Fund meeting for the 7th of September 2024. To start off with item 1. Apologies.
We've had apologies from Councillor Walter and Councillor Suttle.
Apologies. Minutes of the meeting last held on 25th of June 2024. Is everybody happy that they're a true and accurate record of the meeting? Anyone need to make any changes or anything? No? Okay, in which case I will sign. Public participation.
We've not had any questions or statements from the public.
Anything from councillors?
We've not had any questions or statements from council-elected members.
Okay. Are there any urgent items?
No urgent items.
Okay. Going on to item 7, which was going to be Laura Chappell. Laura has been asked to go to Secretary of State.
Minister.
To talk about a large number of things that are going on a national level related to pensions. And yes, obviously it makes a lot of sense for her to be there.
Yeah, absolutely.
There you go. So we will come back to the issues of Brunel a bit later on in the agenda. So we'll jump to item 11, which was originally the independent auditors report. Yes, go on.
Okay. Thank you. Yeah. So this is the so when the Pension Fund's annual report for 2021-22 was approved by the committee in November 22, it was noted that as part of the wider delay nationally in completion of local government audits, the report of the independent auditor regarding the financial statements included in the annual report had not been completed. So at that time, no major findings were anticipated. We did receive the auditor's report yesterday. Apologies for very belated getting that across to committee members. But we also have Ian House, who's an audit partner at Deloitte, who's joining us online. So just to give us an update, if that's okay, Ian, and then just answer any questions that committee members may have.
Thank you. Yeah.
Thank you, committee, and apologies for the late report. That was nothing to do with David. That was down to us and not David. So no need for him to apologise. Apology from us. I'll just take you very quickly through it because there's nothing. It's a pretty dull report in that it's all very positive around the position on the accounts. So we're very much there in terms of completing the audit. There are a couple of outstanding small areas of the file to be reviewed by a third-party reviewer that we have as an independent check. But I've completed the review of everything I need to review, and the work is all complete. So the report will just be subject to that final completion of those points. But we're very much there in terms of doing the work. We only identified initially a significant risk in relation to management override of controls. That would be in any audit that's completed anywhere in the world, but you would have that as a significant risk. So it's nothing specific to your controls or your pension fund. We also identified some of the directly held properties that, having done some risk assessment on those, we identified a number of those were a significant risk of misstatement, largely because of the type of property assets that they are and the ability of us to manage, to easily measure their valuation. So we used some property specialists to look at those valuations, and they had no issues with the valuations that are included in the accounts in respect of those assets. They raised a number of points for the valuation process, but they are more, nice to have and would be good to put in place rather than anything significant in terms of the accounts that we are auditing. Other than that, we've identified one misstatement which is not material, and that is what we call a stale pricing difference. So when the accounts are put together, they're obviously based on the latest information available at that point in time. when we come along and do the audit a bit later on, sometimes there's more up-to-date pricing information. When we've looked at that up-to-date pricing information, it shows that the assets of the fund were understated at the point the accounts were produced by about £8 million, which, as you will appreciate, given your knowledge of it, is not material, and certainly not material in relation to the levels of materiality we set when we did the audit, which were 37 million, as being something that, if it was wrong by that level, then it would clearly mislead the reader of the accounts. So we've raised it as an unadjusted misstatement. You could clearly ask for it to be adjusted, but we would be happy if it wasn't, in terms of giving a clean opinion on the accounts. The rest of the report really just gives a bit more detail on what I've included there, but that's the key messages that we've got. On slide 13, it showed the sale pricing adjustment this year and one that was there last year, but obviously with the updated pricing this year, that becomes irrelevant in terms of this year's accounts. And then there's some very minor disclosure misstatements that we've highlighted on pages 14, 15 and 16. So they're things that ideally would be in the accounts, but we don't consider them significant in terms of the understanding of a reader of the accounts, and therefore we're comfortable in not included, but we would recommend they're considered for future accounts. And then finally, some control findings from our IT specialists and from our valuation specialists. And that is it. Like I say, a very positive report. It shows that the draft accounts that were put together and approved were materially correct, and we had no corrections that were made to those accounts as a result of quite a long-running audit.
Indeed. Hey, did you want to?
Yes, thank you. So I'm Aidan Dunn, Chief Finance Officer for Dorset Council and Section 151 for the Pension Fund, Dorset County Pension Fund. So first of all, thank you, Ian, for the work that you and your team have done on this. As you say, sort of slightly delayed in terms of the timing. So I think that's reassuring for us all, the messages we're hearing about the accounts. I'm sort of mindful that these are 21-22 accounts. We've got another set sort of under audit at the moment, 22-23 accounts, as well as 23-24. That's so there's sort of quite a complex picture, but I think the main message is really reassuring for the committee, so that's good. And I'd also like to pay tribute to the hard work of my team, the Dorset Council team, that put tremendous hours of work to get to this standard. I think I'd like a quick question on governance, because Ian said that these are draft. It's not fully signed off, Ian, is that right? You've got to do a final review. So I'm just wondering if you need a delegation, Chair, just to kindly finalise the formality. And then if there are any other questions on these accounts, I think that'd be helpful. But then I would like the opportunity to have a quick discussion about the 22-23 accounts. Yeah.
So just for clarity, we give an opinion on the council's accounts, which includes the pension fund accounts as an appendix. And then we give an opinion that the appendix is consistent with the pension fund annual report and accounts. So therefore, I can't sign this bit until the council bit is complete. We're very nearly there with the council set of accounts. They're slightly behind these in terms of most of the field work is done, but there are a couple of bits requiring to be completed. So when they all come together, we will sign them all as a package, which is the way it has to be. Unfortunately, I can't sign the pension fund accounts without the council accounts. But I have no reason to believe anything will change from that has been presented to the committee today. And my intention is to issue an unqualified opinion on both the council's accounts and the consistency account opinion that I referred to.
I'm just trying to work out, do we sort of here, are we accepting the report as is? And if there is any kind of minor, any material changes, we'll report it back to the committee. But other than that, we'll assume that's acceptable. I think it's probably the best way.
Yeah. Okay. Could you just hold up?
Just a quick query on the actual report covering this item, because it doesn't, I don't know whether it's just me or whether it's what's on Modern Gov. It doesn't seem to read properly. There's the first page of it,
which is page 103 on Modern Gov, and then it jumps through to bullet point 4. I've only got 2 pages of a report on mine and on Modern Gov. It feels like there's bits missing from the actual report. Sorry, it's just been late. Right.
So it could be there was a late supplement, as Ian said, the papers only came yesterday. So there should be a supplementary page that's got the detailed report from Deloitte. So you might have got the covering report there. It came by email, didn't it?
Yeah.
But it's the actual.
Yeah, just to confuse everybody, Councillor Brown is right that it shouldn't jump to point 4. It should that should be no. There isn't that's the extent of
That is the extent of the report, right?
That's wrong. And just to add to the confusion, there are 2 appendices to it, which are both called Appendix 1. So and one of those reports was late. Apart from that, everything was fine with that. So I do apologise. So Appendix 1 should be the independent auditor's report, and then just for information, Appendix 2 is the pension fund annual accounts reporting, and there isn't a page missing. The numbering's gone a bit wrong, and I've not spotted it.
To go straight from reason for recommendation to the financial implications.
Yes, yeah, because it's basically a covering report.
Yeah, that's
information.
Yeah, the emphasis. Yeah, okay.
Apologies.
So the committee is endorsing this, we're saying, yes, and we don't need a delegated authority to make further changes, or we do?
I think if we could just say if there are any final changes that need to be non-material final changes delegated to the chair in consultation with Section 151 officer should cover.
Everybody happy with that? Thank you very much. Any questions?
So can I move on to the next, the following year's accounts? So this was 21-22 accounts. And I was wondering if Ian, if you could give the committee a quick update on 22-23 audit of the pension fund, not least because it's not just Dorset Council that this affects. It affects many other sort of our members as well. So Ian, can I ask you for a quick update on the timetable?
Just the perfect moment.
It was a particularly difficult question. It's disappear behind the black curtain.
Here he goes.
Just out of interest, can you hear us and can we hear you? Just in case it's not a wider issue.
I can hear you and see you.
Yeah, all good.
Okay. We'll come back to this hopefully.
Let's try.
You hear what we got?
Apologies.
What was the last thing you remember hearing? Do you want to?
Aidan was just talking about the 22-23 accounts, but that's the last bit.
Okay.
Yeah, Thanks, Ian, and thanks for adapting your technology. So are you able to give us a quick update on the audit of the 22-23 accounts? Not least because it's not just about affecting Dorset Council, it's about other scheme members as well.
Yes, so committee, the government has put in place proposals to clear the backlog. You know, as I said with the report that you received on 21-22, ideally you would have received that long ago. There's a significant backlog of audits across the country, so the government has laid legislation that says that any audits not complete by the 13th of December of this year will need to be disclaimed, which basically means no opinion will be given. Unfortunately, in this case, that will apply to Dorset Council for both the council accounts and the pension fund accounts. And then Grant Thornton, the incoming auditors, will pick up the audit for 23-24, ideally as soon as possible, and they've already started to make progress. So as they can give an opinion on 23-24, which they are required to do before the end of February 25, otherwise they would need to disclaim as well. So in order to get to the best position we can in the current arrangements, we will disclaim 22-23, which should allow Grant Thornton to get on with 23-24 and ideally avoid a qualification on, or at least a full disclaimer on 23-24 accounts, and therefore allow you to get back to a clean opinion at the soonest possible. And if you manage to follow that, you're a better person than most. Apologies, it is rather complex.
Okay, yeah. I mean, to say deeply unsatisfactory, it's a huge understatement, but and this is on a national basis, basically, we're just sort of having to put up with it, basically, as far as I can see.
Is it worth restating for the public?
Yeah, Aidan, do you want to briefly say that's newer members who
Yeah.
with background?
So I can give it a version. So from local government audit perspective, the audit's getting increasingly complex. The level of the workforce involved in the audits is diminishing. And generally that has led to an inability, I think, of the audit firms to be able to attract, retain, recruit sufficient people to be able to do the audits, is the sense. That's leading to a real change and churn in the market. So, for example, and Ian, please correct me if I'm wrong, but the real change and churn in the market, so it means that companies such as Deloitte are unable to fulfill the timetables that are required, and that has led to some decisions around some of these audit companies actually leaving the market. So there's going to be fewer audit companies, but that has led to this backlog of outstanding audits, and it's of the hundreds nationally, backlog of audits. And so government is trying to kind of almost force a reset, and that's what this backstop process is. I think there's also an element of this is the complexity of the accounts, as I think we see as well, means that in some occasions it's taken local authorities longer to prepare those accounts, and that's had a knock-on effect for all the other sort of work that these audit firms do, such as NHS accounts as well. So a combination of factors. Ultimately, I think there's a frustration from Dorset Council's perspective. We've got a contract with Deloitte to deliver the audits on time, and there comes a point that that's not being fulfilled. And there's a degree of frustration. So I'll leave it at that point.
I do have one question. Allowing for the fact that government are doing a hard reset, are they actually doing anything, or is the market doing anything to address the problem, or are we simply going to see a repeat of this process in a couple of years' time when the backlog builds up again? Or is there now sufficient capacity in the market to meet demand?
Can we ask Ian's view?
Yes.
Ian, are you able to comment? I appreciate that Deloitte are leaving this particular market, but your sense of conversation with audit firms around the country?
I think my initial answer would be there's been no huge change in the capacity within the sector. So the reset is the focus of government at the moment, which is to do this backstop provision. The restore bit of it, which is aimed at sort of trying to avoid this in the future. The provisions for that, which include changing the route to qualification to be able to sign these audits, additional training of people, is the bit that we haven't really seen any detailed proposals on yet. But understandably, DLUC as it is now, MHCLG as it is now, and the FRC have been focused very much on the reset provisions and getting that legislation through Parliament in time. And then their focus will move towards creating greater capacity in the sector in order to avoid this happening in the future. I unfortunately believe it will take a number of years for this to unwind. And you would hope that the restore elements, the training and the qualification side of things, hopefully will be in place by the time that these qualifications unwind and we're back to a position in 2 or 3 years' time when everything is as we used to know it. I agree with Aidan, it's a wholly unsatisfactory situation. There are many factors that have led us to this point. As a CIPFA qualified accountant who's been doing this all his life, it's not, it gives me absolutely no pleasure to be in this situation. And as Aidan said, it's widespread across the country, but clearly not where anybody wants it to be. And I understand the frustration of Aidan and his team that they're caught up in this.
Councillor Beasley.
Thank you, Chairman. I've got a couple of questions, if I may. I think they're probably better answered by Aidan Dunn than they are by Ian House, on the basis that they are predominantly around Dorset Council and the audit process. So if I'm clear about this in my own mind, it's likely, or it's been decided, that 22-23 will be disclaimed. So therefore, we need to focus presumably on 23-24. And the reason for me asking questions is that these delays, as Aidan being only too well aware, have caused significant problems for BCP Council, who are audited by Grant Thornton. So I don't know whether it speeds up the process that both audits are being conducted in the future by the same firm, probably a different team though, so it may not. Those issues have been long-standing, and the outcome is unsatisfactory, as you've already said, Chairman. And I think in terms of public accountability and what the public may or may not understand out of the process, there is an alarmingly low degree of clarity in all of this. So getting that message out that all is well but has proven very difficult. So this all began when I was still chairing audit governance at BCP Council, and obviously it's ongoing to today. So I'd like to ask Aidan, if I may, whether he is of the view that there will be further delays, and if there are, how we can best mitigate those, both as far as BCP Council is concerned, and no doubt other councils as well, and also how we can convey that message with clarity to the residents we represent. Because I think that is the key to the thing. It's not about technicalities. It's much more about plain speaking and understanding of members of the public. And I know that, if I may, that Aidan and his team have done a very great deal to try and coordinate this across certainly Dorset Council and BCP Council as the two biggest councils concerned. And we're grateful for that, but it hasn't stopped misinformation and criticism of others, myself included, in the process over which we've had no control.
Yeah. Okay. Thank you. I'll try and pick up a few themes in there, and got Sean Creamer online, who might be able to fill in a bit more of the detail. So absolutely the shared frustration and the impact on BCP and others, Police Authority and others. And so over the last 6 months or so, we've tried to bring together. So Ian's been meeting with the GT, the BCP auditors, just to try and manage information flows and expectations. So I think for the 21-22 accounts, which we've just pretty much completed the audit, a bit of sort of mop our brow, that's a relief. I think the 22-23, we've heard from Ian that they're going to be disclaimed. I think we need to work through the detail and the implications and the timing of what that means for BCP and others. And I think Sean, you might have invited Ian to the pension board, which is where employers will be, other employers will be represented to understand that in a bit more detail. And thirdly, for 23-24 accounts, Grant Thornton are the new auditors, and they've hit the ground running, haven't they, David? And are coming. So as new auditors for us, or initially you'd expect them to want to go into a bit more level of detail, as you might at the beginning of an audit section. But given the likelihood of given the disclaimer as Ian's described, there's a further risk there of the audit that they'll be doing. So Grant Thornton have resourced and have come into Dorset Council, looking at the accounts, looking at the pension fund accounts in a level of detail that's impressive, unless you're on the receiving end of it. So there's a degree of thoroughness that is reassuring, or should be reassuring to the public. So coming in on the angle of the public, I think the fact that there's a disclaimer and effectively the 22-23 pension fund accounts, £4 billion, hasn't had a thorough and completed audit could be of concern to the public. So I think we need to be very clear. What we've just heard is we've been given pretty much a clean bill of health on our 21-22 accounts. We'll have a very thorough audit on our 23-24 accounts. So 22-23, whilst not fully completely audited, there'll be a sense that Grant Thornton will be looking at some elements of that to give themselves a reassurance for the starting line. So I'll sort of go back to Ian's point. It's an unsatisfactory set of events for the public finance community. I think we're making the best of a really difficult situation. If there's any communication we need to make to the public to provide that reassurance, then I'm all ears. I think we're making the best of a difficult situation. But I think if I can use that to set the scene. Sean, is there anything in particular sort of on the links with I know the police have been in touch with us as well. Sorry, the police authority have been in touch with us about their accounts as well as BCP. Sean, are you able to comment any further on that?
If I actually under oath, if I'm commenting on the police have been in touch. So I'm Sean. I'm the corporate director for finance and commercial at Dorset Council, and so the only thing I would probably add is on the focus of 23-24. So the deadline for 22-23 and all prior years is the 13th of December to essentially be disclaimed as part of the backstop arrangements. And we've then got until the end of February to resolve 23-24. So that basically gives us about 10 or so concentrated weeks, obviously aside from Christmas, etc., but 10 or so concentrated weeks on the 23-24 audit. As Aidan mentioned, the Grant Thornton team have been, their presence has been felt, and therefore there's a lot of work going on. So we remain confident in the 23-24 and therefore providing the most up-to-date set of accounts for the kind of scheme employers to receive their assurances. It's also probably not worth losing sight of to some extent with the pension fund accounts. The most significant thing people are interested in really is the valuation of the assets as at the end of the year. So as ever, getting the most up-to-date valuations and the assurances on those are most significant for the accounts going forward. So we're confident that the work we're doing in Grant Thornton means we'll deliver on that.
I just wanted to follow up on what Kathy said. Maybe what we need is a very simple, straightforward, plain English type an attempt to explain this to the council members at the very least, who when the public do contact them. Presumably this will get reported back into the cabinet and both authorities as well. So at some point, something needs to be available for when they're contacted by members of the public or by journalists or whatever, there is something to say.
I think members of the public, journalists, as you say, and the sort of other employers that make up this scheme, because there's many of those. So I think we can take that away as an action point. Thank you.
Anything else?
Just one matter. Adrian Felgate, the scheme member representative. Clearly, I like to keep my colleagues and the scheme members abreast of what's going on. So, is there an embargo on what we've heard today? Would you prefer that I didn't report on this for a little while? As Ian has said, that he suggested that there will be a disclaim for this following year, other than the one that we're actually seeing today. Is that something that you wish to be made public as yet, or?
I think it has been. We are a public meeting.
Yeah.
This is a live event, so everything that we said today is already in the public domain. Effectively, it's a question. People might not see. They're more likely to see a report back to the full cabinet or something like that.
Yes.
So having something in place ready to go would be useful.
Yes. So I think on that very point,
yes,
clear digestible comms.
Yes.
Explains the situation and the implications.
Yes. Be better. Simpler for me because I can simply point to that digestible comms. Thank you.
Anything else on the site? Which is, thank you very much, Ian, and hopefully we'll make the best of the situation anyway. Thank you.
Thanks, Ian.
Right, we'll go back to item 8 on the agenda. From Councillor Beasley's report on Brunel and other issues.
Thank you very much indeed, Chairman. And there are a few issues, as you would expect, in this cycle to report on. I last week attended the LGC Investment and Pension Summit in Birmingham, which obviously, given the timing and the announcements from the government, particularly regarding the LGPS and the pensions investment review and the call for evidence, which David Wilkes will deal with the detail once I've finished, Chairman, because the timing of that is now, and it's over a very short period of time. And I'll refer back to that in a moment, if I may. I think just to deal with this in sections, first of all, to deal with Brunel and the sort of high-level stuff that doesn't come through perhaps in an investment report, but is still important to us. So the last meeting of Brunel was on the 5th of September, so relatively recently, to report that Brunel assets under management are now £35 billion, and that is as a result of 86% transition across all 10 funds in Brunel. These are interesting in as much as it does give us a flavour of commitment. And I think that's as a high-level figure is a very substantial commitment that calls that are in existence. So in quarter 2 for Dorset, our transition was 84% against that 86%, but that needs to be taken in the context that there are 2 outliers within Brunel who have transitioned reasonably less. So the Environment Agency transitioned just to 63% at the moment, and Wiltshire at 68%, which interestingly, and I don't know why it is a reduction from the previous quarter, which was 70%. So those 2 outliers, of course, have brought down that overall transition. So I think we're probably slightly behind to a further extent than the 2% that I've just outlined. But nevertheless, we know what the reasons for that are, because we've got substantial investment in real estate, in private equity and in infrastructure, all of which will be transitioned in terms of their value over time, but it will take substantial time. I think what that tells us is that the commitment in Brunel by the 10 participating funds is very, very strong. And we need to bear that in mind in the context of what the government are looking to do, both about pooling in general and about specific investment, which have caused quite a bit of concern. Now, I know David Vickers is online as we speak, and he'll no doubt say a little bit about it when he does speak. But I know that fairly soon after the election, David was a part of a group that met with the new Chancellor, Rachel Reeves. And since then, Laura Chappell, the Chief Executive Officer of Brunel, has attended the Prime Minister's business reception back in the summer. And as we know, today is with the Pensions Minister, Emma Reynolds, hence her not being available for us. And this is, I've emphasised, moving at some pace. Whether it sustains that pace will remain to be seen. A lot of this is about trying to get instant feedback, I think, from the pools in particular. And there are many views on this, particularly over what she's spoken about in the past about the Canadian model in particular. And I think the view from Brunel generally has been, let's make pooling work across the universe of the LGPS. And then we can look to the government to direct whatever it is they're seeking to do. Always remembering that pooling has never been mandated. Important principles. And that those who have participated actively, as Brunel has and as we have, with a lot of caveats and a lot of challenge, are those who are setting the example. There are plenty of others within the LGPS who are at best laggards in this process, and it won't be any good the government talking about the coming together of pools, resulting in less pools than there are at the moment, until or unless all funds are totally committed to pooling. I hope it won't be necessary to mandate that. I think that would be a big backward step for lots of reasons. And so we should be assured about that. But of course, what we're seeing is this focus, if you like, on bigger is better, without necessarily thinking about how we get to that position. If you look at us, if you look at Brunel, if Brunel were to grow from the current 35 billion to some target figure, which we've heard lots of figures, haven't we, Jem? We've had 50 billion before the election. Some talk about 100. Remember, the LGPS is just under 400, so that would take 4 pools. It is the disruption that would cause. It'd be far greater disruption, I suggest, than in setting pools up in the first place, not least because we would either have to grow by absorbing others, or others would have to grow by absorbing parts of us, not probably all 10 together. And that will act as quite a distraction, I think, across the LGPS. And it's therefore likely that our predominant preoccupation of performance would suffer as a result, almost inevitably, and it would take a long time to do at some considerable cost. So I think the roles that people like David and Laura are performing in these discussions with government are absolutely critical in making sure that government understand that commitment. They understand that some of their objectives can be met without actually accelerating that part of the process, and therefore making sure that performance remains at the very, very top of the agenda. And I wish them very well with that. At the conference I went to last week, I think it's important to say that the last session was entitled Assessing the Current Landscape of the LGPS. It was about actually hearing from the horse's mouth what it is that the government are intending to do. And the 2 speakers there were Joe Donnelly from the LGA, who is obviously very focused on the position of the LGPS and the effect that has through the LGA, and Teresa Clay, who is the head of local government at MHCLG and is somebody who attends the Scheme Advisory Board on which I sit, and always tries to bridge that gap, if you like, between the department and the scheme. And it was interesting hearing her take on all of this, not least about the call for evidence, because that call for evidence has led a lot of people to think that 2 weeks or 3 weeks period is a consultation process, which is obviously a record speed for anything the local government do that quickly. She was very, very specific that it is not that. Consultation process will follow once the call for evidence has assembled the evidence that they are seeking. I'm repeating what she said. I will sit there and see what happens. And I do hope that there is proper, meaningful consultation out of here. And I hope one of the things we do at the Dorset scheme is to emphasise that in whatever it is that we return, that it's absolutely critical that there is meaningful consultation that the government can then understand comprehensively across the LGPS, because without that, there will be temptations in there about directing our investments specifically towards infrastructure, inward investment in K, whatever it happens to be. And of course, our fiduciary duty comes before those all the time. But we need to make that, I think, very, very clear in the process. The other thing to say about Brunel, it might seem relatively minor to members of this committee, but it is one of many things that occupies the time of those of us who sit on Brunel, is that we've approved the internal financial budget for 24-25, which is at 15.3 million, and there is a net forecast underspend at this stage in the year of £196,000. Just to reassure, because we always worry, don't we, by the bureaucracy over which we don't have as much control as we'd like. That goes through a lot of hoops to get to that point, and it does have considerable challenge from members of each of the 10 schemes when we're talking to Brunel. So I am convinced that those figures are sustainable and that they are appropriate. Moving on, if I may, Chairman, to the Scheme Advisory Board, which is, for those who don't know, is the body set up originally by government, which acts as the conduit between the department, MHCLG, and the LGPS. There are 6 councillors who sit on there, and I'm one of them. And our last meeting was on the 22nd of July. Our next meeting, which will obviously be reflecting a lot of what I've just spoken about, is on the 25th of November. All of this is on the LGA website, by the way, so it's no attention. Roger Phillips, who is the chair of the Scheme Advisory Board, has already had engagement last week with Jim McMahon from the government with regard to the LGPS, and is meeting with Emma Reynolds, Pensions Minister, as well. Don't think it's today, but it's imminent, because it's important that he understands what position the government is. I was fortunate at conference to be at the LGC Pensions and Investment Seminar. I was fortunate to be able to sit down with Roger Phillips and discuss the current situation where his thinking is going, because I wanted to make sure that we were all aligned, and I think we are. And I think that we'll just have to wait and see, actually, for the next stage, Chairman. But these are critical times for the LGPS, and it would be very unfortunate if it stepped in the wrong direction because the government is in a hurry and because it believes it can enact things through the LGPS which are simply not possible. I'd much prefer to see all of this work that we're doing in the SNB coordinated in a way that will be sustainable for the various schemes, but also stands a much better chance of being adopted so that the government manages to press its own agenda. I think that's just about it. For those who are interested, I don't know how many of us get pensions age, but I did a round table with them just before the election, and there are more quotes in here from me than, because I've repeated this verbatim, more quotes from me than I ever envisaged possible, and most of them are about, what the next government, as it was then, what the ambition might be around the LGPS. It makes interesting reading the election having taken place, and I'm happy to say I agree with everything I said. Very happy to take questions, Joe.
Any questions?
Just one, I'm not sure whether I'd better direct it to you or indeed to David Vickers. We heard previously that there'd been some churn within the Brunel Pensions Partnership and that there were some holes in the amount of people that were employed. Do you know if they've achieved full employment or a good working standard of employment?
Shall I pick that one up? Or
Can I do a piece about the sort of history, and then perhaps David, you can do the current. I think that would
Thank you very much.
the best way around.
Yes.
So there were concerns expressed by a number of the funds in Brunel some time ago, because we set this. Always remember, and I chaired the body that set Brunel up in the first place. Always remember that we did this at considerable pace, and we knew that we would have a number of issues to go back to. Governance being very high on that list, because there was no chance of being able to do all of this in the time that we planned to take. And we recruited literally as we went along. And the recruitment process, I think, led to it not being a finished job. So therefore, some people did leave. There was churn. And that process, I think, has stabilised.
Excellent.
I don't get the feeling or the impression that there isn't a coordinated team there, and that given the location of Brunel in Bristol and not in London, I think that we've done very well on recruitment. Well, I say we, the Brunel professionals have done very well. There is one thing that I would like to just add to that before handing back to David, and that is that right at the start, we appointed Denise Le Gall as the chair of Brunel. Denise left in a very planful way, because she's done it for a long time. She left last week, and so therefore that is a big change, because that will, to some degree, will cement or change direction of Brunel. But I'd like to pay tribute to the work that Denise did during that period, and I think she's been a huge success. So, Chairman, with your permission, if I hand back to David for the current position, that would help.
Sure.
Yeah, I think I think Councillor Beesley was spot on, and it was before my time. But I think Brunel was started with a vision, but without AUM, and they were, and Steve will know this from his time on the board. I think the commitment that was shown early on meant the wishes and asks and requests came a little thicker and faster than perhaps was envisaged. I'm told when the business was set up, there was no real inclination to do private markets, and yet 4 years on we stand here at £9 billion in private market investments. And so it's kind of, rather than build it and they will come, it's they will come and then we will build it. But I'd like to say that we are now at a point where I feel, I have some regulatory responsibility, well, quite a lot actually. If I ever felt, or if I got to a position where I didn't think the team, I had enough people to do the job, I have to put my hand up and talk to the FCA. I've never been there, I've not got there. But, we've had a few scrapes along the way. It doesn't help that the salaries that can be enjoyed elsewhere are a multiple of what they are in the local authority world. But people have come to Brunel, lots through personal reputation. So I've managed to attract a few people here, as have my other senior team members, but because they want to be sustainable and because they share in the ethos that the 10 partners have put together. And quite frankly, lots of them didn't want to potentially work in the city where practices, should we say, are a little sharper. and relationships a little bit more difficult. So we're up to full strength. About 18 months ago, we were struggling. We lost a lot of people who went to all sorts of organisations. One of them went to the church. So not somewhere you really associate with the most high paying of salaries, if you know anything about the church. But yet she went for a salary greater than all of us combined almost. And so we had to have a bit of a reset and a think about our human resourcing plan. But with your help, that's now in place. We've recruited successfully. And one of the things we offer is a bit more flexibility. So we don't ask for people to be in the office 5 days a week. They can work from where they want, as long as they come together when we need them, and as long as the outcome from an investment process is what I would like to see. So, yeah, I think we'll always have our cap out asking for more, because every cycle you guys sometimes, or collectively, the partnership wants a few more things, more funds, more services, more regulatory reporting. So it does feel like I'm always asking for cash, but that somewhat is because we're catching our tail as the business grows every single year I've been there, certainly. But we're in good stead, thanks to your support. So thank you.
Thank you very much.
Thank you.
Any questions?
Chairman, could I then ask David to talk about the call for evidence? Might help if I just read to the committee
The summary government have supplied.
Yeah.
You may have a view on the summary, but a call for evidence has been published inviting input, data and information from interested parties to inform the first phase of the pensions investment review. This first phase aims to boost investment, increase pension pots and tackle waste in the pension system. So back over to David.
Chair, thank you, Councillor Beasley. There's probably don't have a huge amount to add to the previous, just about the practicalities about how we propose to respond to that. So, as Councillor Beasley said, this was published actually on the 4th of September, and they're looking at response the 25th, was it? So not a lot of time, and not a lot of time to sort of prepare something and then share it with the committee and debate it at the committee. So how we're planning to propose to it is that we're having conversations with Brunel and the other 9 client funds. We'd like to try and get as much commonality in our responses as we can, but we do need to recognise that everyone's at slightly different places and they may have slightly different nuances in their responses. How we're proposing to respond is to obviously for me to draft a response to then discuss with Aidan Dunn as the Section 151 officer, but also the employer, a shareholder representative on Brunel for Dorset, and Councillor Beasley as the Ob Oversight Board representative from Dorset. So effectively the representative of this committee. So to agree that, and then we'll share it with the chair and the vice chair and submit it would be a proposed way of dealing with that. At the same time, as I said, we're in close consultation with our other 9 Brunel client officers and with Brunel as well, so that we can share those responses. But I think the key message, and Councillor Beasley's already kind of alluded to this in a way, is that one of the themes from what's driving this by the government is more investment in the UK. I think one of the key messages that I think we'll be trying to incorporate in our response is that if you want more investment in the UK, it's got to be investable opportunities and it's got to be fitting with our fiduciary duty. But to a certain extent, that's an open door. If that can be, investment in the UK can be made more attractive to the LGPS, then that's great for the LGPS, and it's great for the Dorset Fund, and it's great for the country. But the other part of the message, which Councillor Beasley alluded to, is if you want that, you want to kick off a big restructuring consolidation exercise within the LGPS, that's going to suck up lots of time, energy, and money. And the benefits of investing in the UK are going to be delayed by that, not improved by that. I think if the LGPS was invented tomorrow from a blank piece of paper, we probably wouldn't have 80 plus funds or 8 pools or whatever, but we are where we are to an extent. Pooling is still in its early days. We're still going along that route. I think it would be quite a huge distraction, a huge cost and disruption, as Councillor Beasley said, for the OGPS to go through a fundamental reorganisation. So that will be the key messages that we're trying to incorporate. At the end of the day, if the government decides it wants to go in a different route, then we'll have to adapt and deal with that as it comes forward. But that's the message that we're trying to push, and I think that's generally agreed with the majority, if not all, of the other clients within Brunel.
So, I agree. I think the important thing is we provide the government some other way to achieve what they really want, which is more investment for infrastructure, I think. And if we're able to do that and show that you do it with the current structure, make it cost effective and deliver on what they really want, they're on their agenda, then hopefully it'll get somewhere. But like we always say, and we all know with this sort of situation, bright new minister, very determined to get things done. But yeah, there was a lot of pressure on their time to do that, and but we'll be prepared for that. Thank you very much. Anybody else?
Just for clarification, because it's a call for evidence, anybody can provide evidence or information. So we've specifically been invited, and are we going to comment just as Dorset County Pension Fund, or are we going to comment as part of Brunel, the group?
There'll be a response from, I think there was I certainly would say this from Dorset, and I think this is agreed with the other clients, that actually we want to respond separately on behalf of the Dorset County Pension Fund, but we want to try and saying something completely different to Devon and Cornwall, etc. Which I don't think we will. So we want to align that. But as you say, it isn't restricted to the pension fund. As far as I can see, I think anyone could respond. And I know Steve Tyson's the firm of advisors that you work for discussed whether or not to do a collective response from the firm of advisors and other participants, actuaries or consulting firms. I no doubt will respond as well to it.
Yeah. And really our greatest issue is the very short timescale which has been given for producing that evidence. Not that we can't provide it, it's just that we've got a very, very tight timescale to do for. Yeah, thank you.
Right. Okay, well, thank you.
One other issue I just wanted to raise separately, but it does align with this. It's a piece of work coming through the Scheme Advisory Board from Jo Donnelly at the LGA. And she has prepared some notes, a short paper on fiduciary duty and LGPS governance. It's not that long a piece, and it's in draft at the moment. I spoke to her last week because I would be very anxious when it's out of draft to circulate that to members of this committee. It would, I think, be very helpful to understand, if you like, the central policy being put forward, because we all get in our inboxes criticisms, complaints and questions about investment strategy in particular, and it does give everybody then the opportunity to reply in a consistent way. So I will do that as soon as it's out of draft, and I think through the Scheme Advisory Board I will be encouraging all to do likewise in other funds as well.
They sound like they're very, very helpful indeed. Yes. Anything else? In which case, thank you very much. Now we'll move on to item 9, pension fund investments. David.
Thank you. So I'll introduce this, and then Steve Tyson can. So we have Brunel online as well. So. Just referring to the brief summary, really. So we've got the value of the assets at the end of June, 3.9 million.
Bit of a drop, by the way.
Market crash. Just someone called. And the return for the quarter was 1.1 compared to for the year was 11% compared to a benchmark return of 30.2. I think in the quarter we still saw that inflation was remaining more stubborn than perhaps we'd had been hoped for, certainly at the tail end of 2023, and expectations for interest rates had slowed down. Conscious that we're now sort of two and a bit months further on from this now, and again, we've seen in quite a few of these reports for probably last year is that performance of the markets has been driven by the performance of the so-called Magnificent Seven, the mega cap stocks. Although I think they have sort of got to the Magnificent Five, perhaps the Magnificent One, or and we highlight the significant concentration. One, the significant concentration risk that shows in terms of passive investing, but also it's produced a challenge for active managers generally, and I'm sure David Vickers or Tim Dixon will sort of expand on how that's actually panned out up to the end of the June, but perhaps more importantly now what's been happening in the couple of months since then. As Councillor Beasley already said, I had 83%, or Councillor Beasley said 84% of our assets. I think it's a rounding in there somewhere. And the reasons why our figure isn't higher than that have already been alluded to by Councillor Beasley. So the fact that we're the one Brunel client that actually has a directly owned property portfolio, all the others invest in pooled funds. So that's one of the main drivers. And then we have so-called legacy investments with private markets managers that are very costly and difficult to get out of and move across, and therefore you need to kind of rely on the natural cycle of those investments. And committee members will, remember this morning's training that we had about private markets and the liquidity, etc., etc. So actually, I think in terms of assets transferred across to Brunel, I think we've transferred all the assets that we reasonably could have been expected to transfer across to Brunel. One other thing just to mention in there, again, that kind of refers back to the training we had this morning, the pension funds investment strategy has been amended to include a target to transition investments to net zero greenhouse gas emissions by 2050 or sooner. This was agreed in principle by the committee prior to the elections that we had in May, but there were a couple of caveats that were or concerns that committee members had about the wording of that, so that it didn't rubber. At some point, we didn't make ourselves a hostage to fortune, and at some point in the future, if we felt that was rubbing up against the fiduciary duty that Councillor Beasley's just talked about, that we'd be able to sort of look at that and nuance that. So quite belatedly, I have to say, I've included a form of wording, suggested wording to include in our investment strategy statement, just to sort of formalise that commitment 2050, and that would bring us into line with Brunel's policy. Other than that, I didn't have anything else I wanted to say as part of the preamble.
David. Steve.
Yeah, thank you very much. I've changed the format of my report slightly, so I'm welcome any feedback on that. What I've done is I've put the Dorset specific section at the beginning of the report rather than at the end of the report, and I've relegated the economic and market commentary to kind of slightly later with the charts. And that's because kind of in many ways we know what's happening with the economy and the markets, and what's important is reporting on our specific issues. And so I'd like to put that first and foremost. But if you have any feedback on that, please let me know. This first page of my report tends to spend quite a bit of time on public equities. That's because basically it's probably the majority, well, it is the majority of our portfolio, and that tends to be what's driving performance. So that's I tend to highlight in this first page and a bit what I think the key things are. So David's already mentioned the performance, 1.1% up, but behind benchmark. So, we've had a number of kind of negative periods of performance, and that's accumulated now into a cumulative performance of like 3, 5, and even 10 years that's now behind benchmark. And that has been really since we've delegated to Brunel. But as I make it clear in my report, there have been a lot of headwinds that Brunel has had. And I have got some sympathy with the position and the headwinds that they've faced. We've not only had COVID, we've had the Ukraine war, we've now got this distorting thing called the Magnificent Seven, which I personally think is rolling over, and I think it's quite dangerous. And so I think we've got to sympathise, but at the end of the day, we don't want to be lagging our benchmark for very long periods of time. And, so that, we look forward to some better shorter term periods of performance. We really do need that because that will make things turn around in the longer term. So that's the thing that I suppose more than anything else I'm most focused on. When that performance turns around, perhaps in a few minutes, David might sort of update us on the current quarter. So I've highlighted when I say Brunel portfolio comments, there are a few notable features: the underperformance of global high alpha equities and global sustainable. I think that's to do with the Magnificent Seven. We've discussed this quite extensively at committee. Emerging market equities and global small cap performance outperformed in the quarter, but they've not been so great since inception. And of course, the Magnificent Seven is not really a factor in those areas because the Magnificent Seven are not in the benchmarks for emerging markets and global small cap. The passive funds have been the best performing of our equity funds overall. I'm concerned about the pure passive indices at the moment. So if ever we had conversations about when we come up to a kind of review our equities of taking money away from some of the active portfolios and putting them in passive is not a safe place to go to, which is why I'm kind of currently intrigued by other things that may be of interest. And I'm quite interested at the moment in a Brunel portfolio that we don't currently allocate to, and that's the Brunel low volatility portfolio. So I think I might come back with a recommendation at the next committee or the one after that to start to allocate to that area, because that, as I mentioned in the training section of the meeting this morning, where there was an illustration of two graphs. One was a lower volatility trajectory, one was a higher volatility trajectory. I think there's a lot to be said at this point in the equity markets for a lower volatility trajectory. And I mentioned actually in the fourth paragraph down there, I'm somewhat uncomfortable with the Paris-aligned benchmark fund composition, which has 73% in the US and 27% in technology. So that's an area that I'm contemplating and discussing with David whether to make a recommendation on. The two fixed income funds are doing better. They're strong. They're ahead of benchmark over the last 12 months. Fixed income is less troubled by the issues of that we mentioned earlier on. Things like the Magnificent Seven doesn't affect them really. And over the page, I talk about the fund strategy, which I think is highly appropriate. It's if you think about it in this way, the fund strategy is effectively the benchmark. That's performed about 6% over 3 and 5 years, 7% over 10 years. It's ahead of the discount rate of 5%, and that's what you want to be. You want your strategy to be ahead of the discount rate. So the kind of big picture is that strategy is fine, but we're not meeting our strategy. You can see that in the performance against the benchmark. And we know the reason for that. And that's been a big challenging environment for Brunel. And we really want that to turn around, and I hope it will. We're rapidly coming up to the next triennial valuation in March 25. It'll be interesting to see what happens to the discount rate when that happens. That's something I think the next training, I think Dave told me the other day that the next training morning at the head of the next committee might have the actuary presenting to us on the actuarial valuation and the discount rate.
Yeah, that's right. We've got the Violet Waddingham, who are the funds actuary. We've got them lined up to sort of just go over what's actually involved in the actuarial valuation, what the purpose of it is, how they do it, etc., and what the committee's involvement in it will be. It's based on the position as at the end of March 2025, so it's probably not see the results until the following in September, with a headwind probably October, around about that time. And it's a key part of the pension funds activity, because it's where the scheme employers all have their rates set for the following 3 years. So the timing, as always, isn't perfect because scheme employees are always looking to finalise or get their budgets started around about October, November time, and we're usually waiting for the actuary to kind of finish the exercise. Then once we've gone through the actuarial valuation, the next step is that we then would look at our strategic asset allocation. So the mix of assets that we hold, so how much we talked about this morning, the different asset classes. So we then look at that funding position that the actuaries calculated, and then look at our investment strategy to see how it dovetails.
Sorry, if you can make one more comment. I haven't said much about like the economy or interest rates. I mean, I don't particularly adds value to my section of the committee, really. I mean, we're expecting some rate cuts this week from the Fed. So the markets in the short term are fixated about that, but that's all part of the voting machine rather than the weighing machine, in my opinion. So I don't propose to spend much time talking about that. And actually, the other thing I was going to mention finally is that there's a Brunel Investor Day tomorrow. That's a really great opportunity for people who are going to it to kind of meet Brunel and quiz Brunel. Unfortunately, it's not a hybrid session, so it's difficult to dial in.
Okay.
Yeah. Sorry. It's really for you, Steve, but maybe David might prefer to answer. I'm new, so I apologise in advance. I'm really coming to grips with this. You said in your report, it says, since Dorset delegated the manager selection to Brunel Pool, there have been more negative periods relative to the benchmark than positive ones. Can I ask how many?
I don't have that number off the top of my head, but it's definitely the majority.
I can probably cover that off actually in very broad terms, if that helps. So
yeah.
Full caveat, I don't know what happened before you joined Brunel. So you'll have to, I'll leave that bit to people who have got longer memories. Against your benchmark, there are two main effects. You have selection effect. So you have a benchmark, i.e. an equity FTSE 100, you underperform it or you overperform it. That's part of that. And then there's your asset allocation decisions also, which affect that benchmark. So I'll just speak to the former, which is the bit we have control of. The main downdraft, and this is a very potted history lesson, so forgive me, the main downdraft of underperformance across the equity franchise, because as Steve said, the fixed income franchise is largely, well, certainly Sterling Corporate Bond Fund has always been ahead over every single quarter. But the big drawdown relative to the global benchmark happened in 2022. You, as David Wilkes has just talked about, you've signed up to have your portfolios aligned to net zero by 2050, but the broad partnership policy has been there for a very long time, which historically means you've been you've been underweight oil since the inception of the portfolios. In 2022, equity energy stocks were up 60%, the equity markets were down 20%. That delta, that difference, missing out in not being in energy and somewhat banks and miners to a certain extent, which go towards your net zero ambition, created a widening of benchmark versus performance. So that one big period, really it was actually the first 2 quarters of 2022 where Ukraine was sadly invaded by Russia, inflation sprang, energy prices sprang, and those were the two. When you look at the results quarter by quarter, they were the two significant knockout rounds, if you will. Kind of rolling forward from there, being a bit more general, the rest of the portfolios since that point, so global small cap, UK equity fund, have improved and are actually getting close back above benchmark. In fact, as we speak today, the UK fund has now gone back above benchmark since inception, despite underperforming by about 6% in 2022. The 2 global funds, Global Alpha and the Global Sustainable Fund, then went into a period, I think as David and Steve alluded to, of the Magnificent Seven and the concentration effect, where actually largely all, equity managers underperformed. And that is relatively typical, if not enjoyable, when that type of rally ensues. So just to give you a kind of a yardstick, over the last 3 years, the benchmark So a passive benchmark, not the PAB one, but a passive benchmark has beaten 75% of all active peers in that space. Now, think about how one has a philosophical view about active or passive. We have both for you to choose, clearly. But that creates a difficult backdrop for, I think, as David said, for all active managers in that space. The sustainable fund in particular has a additionality to its mandate. That additionality is to only invest in stocks that can be categorically described as having a positive impact to society in one way, shape or form. What that means is, and this would be my personal view, but also shared by the fund managers that have been deployed on your behalf, it is quite difficult to think about how Facebook has a positive societal influence on the world. Likewise, Apple. So they have had more reason than most in their mandate, in the way that fund is set up, to eschew to avoid those particular stocks. Global Alpha, much less so, actually. So Global Alpha over the last 3 years has underperformed. For that first reason, the RI being underweight banks, and then there is not really an excuse for not being, well, with hindsight, of course, fully weighted or overweighted in Nvidia and those type of stocks. But actually, since inception, the Global Alpha track record goes back, is one of the first funds off the blocks. It is ahead of its benchmark, and it is one of your bigger positions, and it is in the first quartile of its peers. So I guess the broad message is, and this is how I think about the performance. It's understandable, explainable, but not enjoyable. Is that the last 3 years in being an active fund manager has been terrifically difficult. So very small violin out. But at least with your portfolios, which have this kind of bias built in terms of responsible investment and eschewing certain sectors, there is at least some mitigating circumstances as to why the performance in 2022 in particular was as it was. Subsequent to that, we've had improvements across 7 of the 9 funds. The 2 that haven't improved since that Ukrainian invasion are the Global Sustainable Fund, for the reasons I just slightly talked about, and the Emerging Market Fund, which, whilst I can't share all the details with you here in public session, we are just about to change some of the lineup of those managers to try and rectify and improve upon the existing ingredients in that portfolio.
If I was to ask you to give me a stick to hit you with in the future, what would your predictions be? Would you predict that you're going to outperform benchmark over the next 4 quarters, or
I think
are we going to see?
Without putting a blasé comment on it, I think every fighter goes into a fight hoping to win. So it'd be if I could say to you, I think we're going to underperform. I think I would like to think I'd make changes if I knew that was going to happen today. I think to what Steve said about those large, well, it was 7 stocks, it's now 4 stocks. It was then 1 stock, and now it's no stocks outperforming. What you're seeing is if that concentration continues to ebb and flow in the way that it is at the minute, it doesn't level the playing field, but it creates a more benign environment for active managers to outperform. And that is what we're seeing this quarter. One of those big headwinds is starting to be removed. Now, I say that slightly tongue-in-cheek because, again, with hindsight, and perhaps one should have this if one can, it would have been lovely for all of the managers to have been overweight Nvidia to the tune that it is. It's the biggest growing stock in the world. Last quarter, it did $12 billion worth of sales, a 200% increase on the last quarter. So undoubtedly, the trend has been there because Meta, Alphabet, Amazon have been buying chips like there's no tomorrow, but the valuations have got very heady. I think, as you've seen now, particularly that stock underperforming by quite an amount over the last, well, really actually since the turn of the quarter, that it means that being underweight that is no longer the only decision you have to think about. Because up until this point, what drove performance? Did you own that stock and in how much? I can kind of drop the mic after that when I know the results of whether they under or overweight that particular stock. So it creates a more fertile ground for active management. But I still think, perhaps as was alluded to, philosophically one has to think about whether you want to be active or passive. I have a personal view in different sectors, which I can obviously share with you. But given you have signed up to net zero, it is very difficult to accomplish that and be in a traditional passive index that contains so much banks, energy and oil stocks. So there is that, the Paris alignment is that halfway house. We may over time need to think about realigning that or changing that, but they're the two kind of dichotomies you're faced with today, that the normal benchmark will hit your benchmark performance but as Steve said, has massive concentration risk. So the absolute risk is much higher. Whereas when you go active, you take a more relative return risk than active risk. And also in a passive format, it's very difficult to achieve your net zero ambitions, both at a council and at a pension fund level.
So it sounds, thank you for that, David. It sounds as if your Q3 performance is going to be better.
Looking at the numbers today, so famous last words, it is. We have some time to go, well, not much time to go towards the end of the quarter, but you're right. That would be my assertion as I stand here and look at the soft data that I see coming through my system.
Right. Okay, good. Well, we'll look forward to that. That's good. Is that kind of across the board, or is that... I'm thinking about here, the main ones for us are Global High Alpha, Global Sustainable, UK Active, Global Small Cap and Global Emerging Markets.
So UK Active, yes. Sorry, I'm running down the list. Global, which you're not in, but you were talking about, that's actually up 4% in relative terms because the market's gone down, so it tends to outperform. Emerging Markets, yes, but by a smaller amount. Global High Alpha is just about breaking even. There's one particular manager in there that still owns one particular stock that's causing some troubles. Global Small Cap, yes. Global Sustainable, yes. The Credit Fund, yes. Multi-Asset Fund, yes. So, I mean, there are extents and degrees within that range, and these are soft numbers, they're unaudited, but yes, the direction of travel has eased since the collapse of those one-trick pony names.
Yeah. Okay, can I ask another question? Is that okay? Okay. We had some training this morning, and it was some training for, directed at the fact that we've got a relatively some new members of the committee, and that training was from 91. They came down and trained on asset classes. Yep. I did some asset class training last quarter as well, but they also brought down their sustainability director, and she did some training on net zero.
Yes. Yeah.
Yeah, she is good. But what was interesting, I mean, her message to us was very much about, on the net zero thing, was really about kind of having impact, making a difference in the real world.
Yeah,
and you know this very well. Yeah. So that was a kind of, and yet maintaining performance. Now they've got quite a credit. You have wisely chosen that manager. Yeah. They've got quite a credible story because they're making a difference and they're performing quite well. So, I mean, can you just sort of play that back to us a little bit in terms of, in terms of the other portfolios, like the sustainability portfolio or the other Global High Alpha? You quote the net zero numbers to us in the reports, your net zero numbers to us in the reports. Yeah, I do, have this fear that at the end of the day, we might be sacrificing, some of those managers might be sacrificing return for the cosmetic benefit of showing nice, wacky weighted average carbon intensity numbers.
Yeah, of course, understood. So,
do you understand where I'm going with that?
I do. So my long-term view is that investing, the Global Sustainable Fund leans heavier green than the others. So hopefully that distinction was clear. That's looking for positive impact. The Global High Alpha Fund is just embedding ESG considerations. And the policy that Dave and his partners signed off on was, we've moved away from wacky, actually, Steve, for one of, quite frankly, for that particular reason, because no good looking good if you're not making real positive change. There are some very dirty chemical stocks out there that they're wacky, their weighted average carbon intensity is very high, but they are changing and have a credible plan to change that is approved by the market and helps others change. So we're moving away from wacky and into something called alignment, which is what net zero is really about. Can we get the corporations to be aligned with net zero by 2030, 2040, 2050, depending on when your target is? That's a slightly different measurement, because if you look today, Amazon technically looks like it's a low weighted average carbon intensity stock. In fact, a better example is a car manufacturer. Okay, there is some steel and energy that goes into their process, but if you're still producing combustion engines, which is scope 3, you're actually helping create an awful lot of downstream carbon release into the atmosphere, which isn't currently captured in your figures. So that's why we've moved to an alignment metric. I think if you align with a long-term theme that to me feels very secular, I know we've had ebbs and flows of even in the UK, but certainly in the US in terms of government intervention. It's exciting, we'll push for it, we'll pull away from it, we'll push and push, but I think the for me at least, the writing is on the wall. Climate change is here with us today. And this isn't, I don't think this is alarmist. We are already getting irreparable damage by most scientific, we've had all scientific observations would tell you that the instance of floods now coming across Europe, not just in other places of the world, so coming a little closer to home, mean that this is a thematic trend that is here whether we like it or not. So trying to invest alongside that thematic trend in investment parlance should give you a nice tailwind, a shunt in the right direction. That said, in moving away from energy stocks, and this is where one has to weigh up the pros and cons quite differently in the short term versus the long term. In the short term, it is very possible that energy stocks rally again if energy prices rally, caught by a Middle Eastern conflict or another escalation of the Russian conflict. You are underweight / out of most of those stocks. So that's called basis risk. Your portfolio cannot invest in all the constituents of the benchmark. And so if that small constituents rally a little bit, not a problem. If they rally a medium amount, not too much of a problem. If they rally a la 2020, so up 60 when the market is down 20, so an 80% differential, that is going to cause some short-term performance woes. But you marry up the short-term versus the long-term. As long-term holders, I think, given your policies at the council and obviously the policies at the pension fund now, one, you are not inexorably linked. One should always keep an eye on what you're doing because the world could recarbonise. That's a fairly difficult thing to contemplate sitting here, but all warning signs may be continually ignored. Governments don't get their act together, and a bit like Lehman's going under way back in 20. Sorry, I don't want to create lots of bad headlines, but it took Lehman's going under and for there to be blood on the street for the governments finally to get the message to step in and intervene. There is a worrying thought process out there that one would need to see a lot more damage, a lot closer to home in the developed world for things to actually start to happen in a more meaningful way. So long term, I think you're acting in exactly the right way. That would be my view. But in the short term, there is definitely, as I said, basis risk to contend with. But it's a known basis risk, actually. It's an energy price shock rather than a rebalancing of the world, which is what we also saw in 2022 when inflation went so far up. We went from a world of no rates, no interest rates, to a world of suddenly very high interest rates relativity. And that paradigm change also, aggressively changed the market perception. I hope that made some degree of sense.
I just, it seems to me that on a slightly different subject, virtually every meeting we're talking about the Magnificent Seven and Meta and Apple and the others. Has for those longer term memories, and has this level of concentration, because I read the report, was it 32% of the S&P 500 is concentrated in those 7 stocks? Have we experienced that sort of level of concentration in the past, and where does that end up typically?
It ends up in tears.
Yeah, there's two really big episodes of the tech boom. However, those companies were often without merit, lots of them. I don't think anyone can argue that Amazon is not profitable, and Apple has £400 billion of cash on its balance sheet. It's not going bust tomorrow, so there's a difference. The last very interesting time that happened, and it slightly predates me, but without wishing to age anyone here, some of you might remember the Nifty 50, when the parlance was to invest in the best and brightest of the US. So it was the Cokes, the PepsiCos. They did tremendously well for a very long period of time, and then underperformed when that tide changed very, very aggressively. And that is a quality company. So they bought quality companies, good companies, but they got so overvalued that when it changed, you had a very aggressive reversal in market sentiment. So typically, like anything in life, when things get out of whack, whatever you're talking about, things they don't have to, but they typically do mean revert to a more sensible level. I don't think it's feasible that some of these stocks continue in price alone to appreciate in the way they do. The difficult thing I can never promise, of course, is when that turns. Now, it might have turned. In the short term, it might resurge itself, because what typically happens is people don't own it, get self-flagellate themselves in committees and everywhere else. It drops 30% and they buy it because they think it's a great opportunity, forces it back up, and then it realizes it's just on the other. There's just a continuation of the down. So it's likely to be a choppy down, if indeed we are in a down for those times, but there is lots of precedent for that. I mean, at one stage, BP, much closer to home, was 7% of the FTSE and 15% of the index in terms of its income derivation. So when it had the Mondako spill, that dividend disappeared overnight. So 15% of your FTSE income disappeared, and the stock obviously tumbled fairly precipitously. And so in lots of markets, we get concentration. And the other very broad one was, and again, predates me a little bit, there was one stage when Japan was, I think, Steve, 60% of the global index.
Yeah, about 50, 65, yeah.
And it's now about 8. Today, it's the US that is 65%. I'm not saying the US is going to 8, but we have precedents for these type of concentrations, both regionally and company specific in the past. The question is, when does it change? Probably not if it changes.
So does our sort of future performance very much depend on how we call that, really?
I don't
performance will.
Yeah, I think the short term, and so without pre-guessing what Steve was going to suggest, what I've talked to other clients about, and it's not advice, is the low volatility fund is a great counterbalance for market declines and for the type of market we've been in today, because it is much more equally weighted. It's much more diverse and it's much more defensive. So it really has a role to play. And I think some of the issue we've had is that Global Alpha did very well out of the gate. We launched Global Sustainable on demand from clients, and people jumped in there and perhaps didn't think about the world we now inhabit, which is the concentration effect. So it plays a lovely counterbalance and foil to some of the other things in your portfolio.
As no one else has mentioned this, what happens if Trump wins?
We pack our bags? Sorry, I probably shouldn't say that. I honestly don't know. I like to think, and historically I've always thought that whoever's in government, it doesn't really matter. Now, I know I'm talking to a room full of local councillors, so I have to be careful what I'm saying. But typically, a government cannot affect the world economy. And even if Trump were to be elected, it's unlikely he would get kind of a massive majority in both houses, so he'd be somewhat constrained. But where prime ministers and presidents in this instance have most carte blanches in foreign policy as opposed to domestic policy. And you saw his retrenchment from global institutions last time. That would reassert itself. I'd like to think it wouldn't be a significant change, because last time Trump got elected, every man and his dog thought the market was going to go down. Actually, it went up. Now, he cut taxes an awful lot. So part of the mystery of Trump is you don't quite know what he's going to do when he's in power. And some of it is market friendly, even if it is uneconomically friendly. And so there is a distinction there. But I would imagine more of the same that you saw last time, which is a bit more isolationist, retrenchment from global institutions, which is difficult, makes for a more volatile world, more Chinese rhetoric, which makes for a more volatile world. And I suspect he would like to try and row back some of the Inflation Reduction Act, which is more green energy transition. But that is the main beneficiaries of those acts that Biden put in place are Republican states. So actually, I think he will really struggle and perhaps not want to, because his base has really benefited from some of Biden's support packages, even if they don't like the green transition and they like energy and oil. Actually, the money has flowed into those red states quite aggressively.
I don't think we could do anything in practice, really. It's just, I think some of David's answers there were spot on. We're not going to change our strategy. We're not going to change our choice of Brunel funds.
Your fund will outlast President Trump's residency. I think that's the way to think about it. Your time horizon is very, very long. And,
longer than his.
His is a little shorter. Should be.
Thank you, sir. Okay, anybody else?
Just one last comment, Steve invited comment. I much prefer your latest report format.
Oh, you do? Thanks. All right. Okay, I'll try and. Okay, great. Go forward with that.
Thank you all very much, then. Thank you, David.
Thank you. And if anyone is coming tomorrow, please do search me out. I'd love to have a chat about whatever is on your mind. I'll speak to you next time.
Well, everybody is actually, but yeah, maybe. Okay, thank you very much.
Thank you, councillors.
Oh, the recommendation.
Yes.
Yeah, it's on the second slide.
That's page 14, 2 recommendations. The committee review and comment upon the activity, which is largely done, and approve the revised investment strategy statement. Is everybody happy with that? Both show of hands. Yeah. Anybody else? No. Good. Thank you very much. Then. It's very unanimous decision. Thank you. Okay. And then on to item 10. Karen, over to you.
Thank you. Okay, so the administration report, starting with the key performance indicators as usual. Appendix 1, all very solid. I'm very happy with that. Does anybody have any questions on?
It's not a question, it's a statement.
Yeah, right.
Everything is way in excess of what your targets was, and they're all moving in the right directions to get even better. So congratulations.
Thank you. Yeah, we're getting there. Thank you. Through the cloud update, you'll see from that the key information here is again about the delay in delivery of the software that we need to be compliant with regulations in October last year. We are having into our test environment next week first delivery of some of the software nearly 8 years after the regulations came in. You'll know from previous reports that we've not been happy with our software supplier in terms of the delivery of the McLeod legislation that we need. And we have met with them. Myself and Sean and the chair of the pension board met with them a couple of times. The last meeting was primarily about trying to get some items moved from the January release to the October release. Basically, nothing has changed and they're not able to move anything. So we are sort of stuck and we are where we are with what they can deliver and the timescales. The consequence for us really, apart from the fact that we're going to have a tricky time because we need to be fully compliant by the 31st of August next year. There's an awful lot of work to be done, an awful lot of work. We have got extra resources in and we're sort of ready, but we've sort of been ready for a while now, doing everything we can to be ready to do this. Our worry is the valuation. But one consequence is that really we've been discussing today is sadly we're going to have to delay the move of the pensions payroll into our software system, which has been, years in coming. Extremely disappointed because every month that goes by, it's got some consequences for us. However, there isn't really anything that we can do. So we're looking at our plans in regard to that because one thing we can't risk is the pension payroll. And unfortunately, in January, February, and March next year, we're going to be testing the substantial part of the software delivery for. So just to let you to know about that, that's important things. Does anybody have any questions in regard to that? Yes, one day McLeod won't be on the report. What I'm going to talk about then.
We'll all retire by then as well.
Yeah, probably will. The annual benefit illustration is just to let you know this is a statutory responsibility for the fund and it's a monthly responsibility. And it's a really important thing that we do, which is sending out a communication to home addresses. It's the only one we do each year of an annual benefit statement and a newsletter. So we're very proud of the statement that we send out and the newsletter. I've attached those appendices, you can have a look. It's a very successful and a very important piece of communication. It's really hard in the LGPS, certainly compared to some of the other public sector schemes, to keep in touch with people, to keep them informed of their pension. And it's really, really important that members are engaged with their pension. And we are increasingly up against a lot of communications from DC schemes out there that send mixed messages and confusing messages. So pensions is probably confusing for most people. I rarely meet anybody that doesn't say, this is quite confusing, can you explain? So it's really important that we send out good quality communications in the right way. And this is one of the things that we do. It meets a lot of other box ticking things, for example, in terms of the pensions regulator, that requires us to have current and up-to-date data, for example. So really important, and that was all very successful, and we've had some very good feedback from those pieces of communication. The newsletter as well is also quite important because that's our time to get out key messages that are really important.
The initial stabs at gonaways and so on showed very big numbers.
Yes.
And then when you went back and looked at the evidence, it actually turned out that they weren't as big as you originally thought, that the numbers were much smaller. Is there a reason why there was such a difference?
The gonaways.
I think it was the addressees that you were sending mail to. I misread the report. It's quite.
You're probably looking at the data quality report.
Yes.
Whereas I haven't got onto that. That's the next item. But it is relevant in actual fact because obviously the gonaways, which means we haven't got a current address, that tends to happen for our deferred beneficiaries.
Yeah.
So the number of annual benefit statements we send out to our deferred beneficiaries is not as many as we have because that's where it's hard to get a current address. And that's why there's a difficulty there. With the active members, we have addresses. So any that are returned that have not been updated to us directly by the member or by the employer, we tend to have those statements returned and we go to the employer and say, what's the current address? So the active membership is probably really spot on as it's going to be in terms of addresses. This is one of the common data specifics for obvious reasons. Where it's tricky is with deferred members. They lose touch and that sort of thing. They don't always keep us up to date. We have in the past done big tracing exercises, which are quite costly. We always do tracing near to retirement when someone's coming up to benefit being payable. And of course, next year we're starting the dashboard nationally, although I don't know that will go live until the following year. But the dashboard, which is a national sort of format where everybody can log on to all of the pensions, that will help with this, I think. Because if people utilise the dashboard and everyone will be encouraged to do so, they might pick up their forgotten or lost pensions and get in touch with us. Does that help?
Yeah.
Yeah.
Just a quick question, and thank you. Illustration that I received along with about 4 or 5 other. It always reminds me when they all drop through the letterbox. Really must merge some of these together to some pension transfers, but just actually in 4.2 it talks about plus 28 councillor statements.
Yes.
What the just to my understanding really, are they version of the deferred benefit illustrations or the...
Yes, so councillors used to be able to join the LGPS.
Yeah, which is good.
Yeah, and that is stopped. I haven't attached their statement here because it's not as informative. It's quite much more basic. We have a letter and a basic statement. So we only have deferred or pensioner members.
So that's what I would.
Yes,
yeah.
with the councillors. Yeah.
Surprised it was only 28.
Yeah, only 28. It's not many, is it?
Yeah.
That's just the deferred members. We've obviously got quite a few drawing a pension. Yeah. The data quality report is also a significant bit of information for you because that's where we test our data. We have to test it against the common and specific data requirements, and they're outlined there. And you can see we're pretty consistent with last year, slight improvements in all areas. This is a really handy thing for us to do because it produces a lot of reports on which we can base our cleansing and address any issues. We have some issues with some of the reports that we've got, but overall we're extremely pleased with that, and hopefully that's reassuring for you that our data is as it should be. Any questions in regard to the data or annual benefit illustrations?
Just one, which is following on. I think I'm getting mixed messages here. So we've changed our supplier for the data analysis and our software to party to some of the conversations, pushing Civica to improve their performance in certain areas. And yet you're saying that some of the data reports that we're able to extract from the software is good or very good, but still need some improvement. So is there any merit in us talking in this forum here, bearing in mind it's a public forum, about how we feel about Civica? Or is that better talked about in a different arena?
Well, obviously, it is looked at with the pension board as well.
Yes.
But I think what's important to say is that Civica do recognise that they have struggled with the McLeod legislation, and that it's not been delivered by any means a desirable timescale. The system itself is excellent.
Right.
And one of the things is, are we doing the right thing with this system?
Yeah.
Because we're so struggling with new legislation when it comes in. It's all a bit slow, and it's such a big system.
Yes.
But we would all be very reluctant to move away from the system that we have. It's really, really good.
Yes.
So its potential is huge.
Yes. So they did, in common with a lot of software that we are able to access, the capability of the software is probably greater than we will ever use it as an organisation. And so if we had marvellous people in-house who were able to develop it fully, they would probably be pinched because they're doing such a good job. The software provider would want to have them to do for all the rest of the updates. But in general then, Civica is doing a good job, but we would prefer them to do better in certain areas particularly.
Yes, I would say that the product is good.
Yeah.
It's better than our last product.
Yes.
Civica as a company in regard to this particular product,
Yes.
we have felt somewhat let down in some areas.
Yeah.
And it's only really been because of the expertise that we have in-house
Yes.
that we're in such a good place that we are. Because it is very much a system that has massive capabilities, but it doesn't have ready to roll.
Yes.
It's a put it together yourself kit. So the expertise and you need to be able to deal with this system is much greater than our old one.
Yes.
But what you can achieve is also much greater as well. So there's lots of small things that are really, really, really good.
Yeah.
About the system. So so we're happy with the system. We're just not happy with the company in terms of its delivery of such a significant.
All the aspects. Yeah. Thank you.
An update there on employer movement. You'll see there's 2 employers that have left the fund, and 2 colleges, Kingston Wood and Weymouth College, that are merging. So at the moment, in regards to those, there's actuarial work undergoing in regard to those movements, to those employers. The government changes you'll all be aware of, and John mentioned some of those there. And the last item here is just for approval of a change in IDRP processes from really somewhere that we've been at for a long time. We now want to change it to something a little bit more effective and efficient. Really moving from sort of the onus on one individual, which is quite a big task on one individual, to having a small panel, which is, we spoke to some other funds to find out what they do, because this can be a hugely time-consuming thing dealing with high-level IDRPs. And so we've decided that the panel approach would be a bit more robust in terms of decision-making, and a bit more efficient overall. So that's something for which we would ask for your approval for that change, and then we can go ahead and start any new IDRPs that we have on that new basis.
Anyone have any views on that?
Just to say that I think it's eminently sensible to move it from a single person through to a panel. Yeah. So it gives you much more flexibility, and I'm sure that you'll have much more stable responses.
Well, you've got approval for that as far as we're concerned.
Yes, yeah, that's good. Thank you. And I think that's all. So any questions from anybody? Unless or anything else?
Yeah. Just a comment to say thank you very much for inviting me to be witness, I suppose, on some of the pension board matters. That I found it really educative and it increased my knowledge of the whole arena, and I very much appreciate being able to come in and on that basis. Yeah.
So you're obviously welcome to come to the board. Slightly different angle because obviously you've got some employers there.
Anything else? Thank you very much. On then to item 12. Is as it is.
Yeah, dates for the next meetings, and also just a reminder that we'll have training in the morning and scheduled to start at 10 o'clock. And I think I probably need to learn my lesson and keep it for starting at 10 o'clock.
Yeah.
So I think we could have quite a packed training agenda anyway. So talk about the actuarial evaluation. Training on that would be a main thing.
Yes, I think meeting with the actuary before the whole process of evaluation starts be a very good productive thing for us all to do.
Just to say, I think it's open to local pension board members as well. So whether they'll come in or just join online.
Anything else to be said on that? No. In which case, thank you very much. That's the end of the meeting. Thank you.
Thank you. Thank you, Chairman.
Nice to see you.